Every single day, tens of thousands of retail traders jump into the options market with dreams of turning $500 into $50,000 overnight. They see the viral screenshots of 1,000% gains, fire up a trading app, buy out of the money call options, and wait for the quick fortune. But within 3 months, studies show that roughly 90% of retail options traders blow up their accounts. Why? Because most retail traders treat options like lottery tickets. They are buying hope, while Wall Street and systematic traders are selling probability. In this video, we are going to break down the 3 mathematical traps causing most traders to fail, and the exact framework the profitable 10% use to collect consistent income with the math stacked in their favor. Trap number 1, theta decay or time decay. When you buy a standard stock, time is your friend. If the stock sits flat for 6 months, you haven't lost anything except opportunity cost. When you buy an option, however, you aren't just betting on direction, you're buying a ticking clock. This is measured by theta, or time decay. Every single calendar day that passes, an option contract loses a slice of its value whether the stock moves or not. Notice how time decay accelerates rapidly as you get closer to expiration, especially within the final 30 to 45 days. Buying short-dated options means you're constantly fighting a downhill battle against time. To win, you don't just need the stock to move, you need it to move fast enough and far enough to beat the melting ice cube. Trap number 2, implied volatility crush, also known as IV crush. Have you ever bought an option right before a big earnings report, had the stock move in your favor, and still lost money? That is the dreaded IV crush. Before a major event like earnings, market uncertainty spikes. Options market makers inflate the price of options to account for this unknown risk. The moment the news is released, uncertainty drops to zero, and the volatility premium instantly vanishes. If the stock didn't make a massive violent move, your option contract loses value instantly. Trap number 3, all-in directional bets. The third trap is purely psychological. Most traders insist on predicting exact market direction, going all in on short-term calls or puts. When you buy direction, you must be right about 3 things simultaneously. 1. The direction, up or down. 2. The magnitude, how far it moves. And 3. The timing, when it happens. If you get just one of those wrong, the trade fails. That is a low probability structure. So how do consistent, profitable options traders operate? They flip the script. Instead of paying for time decay and volatility, they sell it. They act as the casino rather than the gambler. Here is pillar 1, high probability mechanics. Instead of trying to guess where a stock will explode to, systematic traders target strikes with a high statistical probability of expiring out of the money by selling cash-secured puts or credit spreads with a delta around 0.30 or lower. You enter trades with a 70% or higher probability of success from day one. The stock can go up, sit completely flat, or even drop slightly, and you still make a profit. Pillar 2, capturing the sweet spot of 30 to 45 DTE. Instead of buying 0 DTE or 7-day lottery tickets, professional net sellers typically enter trades around 45 days to expiration. This strikes the optimal balance between rich option premium and rapid time decay. Many systematic traders then close or manage their trades around 21 DTE or upon reaching 50% of maximum profit, completely avoiding the erratic tail-end risk of expiration week. Pillar 3, position sizing and risk control. Finally, the top 10% never risk their entire account on a single idea. They size each trade so that no single catastrophic market move can wipe them out. By risking only 2 to 5% of portfolio capital per trade, they ensure that even a string of bad luck is just a minor bump in the road, not an account ender. To summarize, first, stop buying short-dated high IV options. Second, let theta decay work for you, not against you. Third, trade probabilities by targeting a win rate of 70% or higher. And fourth, manage risk early at 50% profit and stick to strict position sizing. Options are not a get-rich-quick tool. They are a mechanical probability engine. When you stop chasing overnight 1,000% gains and start managing probability, time, and volatility, you step out of the 90% that gamble and into the 10% that compound wealth. If you found this breakdown valuable, drop a like, hit subscribe, and let us know in the comments below. Do you prefer buying or selling options? See you in the next video.